Okay, hello everyone. Thanks so much for attending our webinar series, Capital Market Development on China and Asia. And this web series is coordinated by 5 institutes and NUS and SAFE Department of Economics, CUHK, and CUHK Shenzhen, and Tsinghua University PBCSF. So we are very glad to have Professor Jun QIAN and Professor Michael Song to give today's talk. So Professor Jun QIAN is the Professor of Finance and Executive Dean at the Fanhai International School of Finance, Fudan University. And he will talk ownership networks and firm ownership, firm growth. And this is evidence from a large sample, 40 million companies. And so the discussant is Professor Michael Song, and from the Department of Economics, Chinese University of Hong Kong. Let's welcome Professor Jun QIAN. And you can start, and we have 25 minutes, and I will time it. Thank you.
First of all, thanks very much to the organizers inviting us to present our work. Second thing is that I guess we can still say Happy Chinese New Year, all right? Wishing you healthy and prosperous Year of the Tiger. All right, so we're going to talk about ownership networks. This is joint work with a few excellent co-authors, Franklin Allen from Imperial, Xian from Durham, and also Junhui. He's a statistic PhD at Wharton, and he's on the job market at the moment. Linda ZHAO is a professor of statistics at Wharton, and finally Zhu, who graduated from Penn Economics last year and is a faculty at Tsinghua School of Economics and Finance. All right, so the questions we're going to ask are important ones and being studied for many years. And that is, look at the firm growth in China. A lot of people in the audience, including myself, have done some work. We know that if you look at China's financial system, bank loans are very important, but bank loans strongly favor state-owned enterprises. China now has a fairly large stock market with over 4,000 listed firms in Shanghai, Shenzhen, and also another close to 1,000 firms from mainland listed in Hong Kong. But these are mostly large firms. There is still a vast majority of small unlisted firms. We know from the aggregate stats that they're very important in terms of promoting growth, providing employment opportunities, among other things, contributing to the economy. But how do they get their financing and how do they grow remains somewhat unanswered. And that's sort of the questions we want to answer. So we know that in prior work, including work using World Bank firm surveys, people have looked at how these unlisted firms grow, but mostly that financing and growth link comes from individual firm level. And that is, we run these regressions looking at individual firms' financing channels and see how that promote growth. Here, what we do is differently. We use information from this State Administration for Industry and Commerce, with abbreviated name SEIC, and that is not 上汽公司, right? That's not the same as the Shanghai Automobile. That's the State Administration for Industry and Commerce, the Registration Bureau, as we know. So basically, all the firms of all types must register with this bureau, from which we got information on the identity and also equity investment relationships. Each firm, how many equity investment it makes, for another firm, how many equity investment it receives. information like that. And based on that, we construct a very large equity networks. So these are stock holding connections among firms, among many firms. And through that, we want to see how whether a firm is in an equity network and the position in the whole networks, how does that matter for growth? And we'll define growth in a number of ways. So as I said, in finance, financing usually comes from debt or equity. For small unlisted firms, typically a very important obstacle for debt financing is that you have these information problems. For bank loans, usually require close relationships. It also requires collateral, right? So how do you overcome these information problems, lack of collateral, etc., is very important for these small unlisted firms. In this sense, we want to argue that these equity investment relationship, especially in a network, is a very good way to overcome this, right? Because once, as a shareholder, whether I'm an individual or I'm a company, once I invested in another company, as a shareholder, especially if I'm a large shareholder, I should start monitoring the firm, right? So arguably, through equity investment and through these networks, that will provide an important channel for these small firms to receive financing, to establish more relationships along the product chains and other channels to grow. And that's sort of the hypothesis we're going for. Since we're doing this, we're mapping out the whole networks. So the first thing we're going to do is we're going to describe the allocation of equity capital once we build up this network. But more importantly, we want to answer the question whether a firm is in a network and the position in the entire networks help it grow, all right? And we're also going to look at using a 0809 shock to see the relationship between the effects of equity network and bank loans. So that's sort of the goals of the current paper. Let me briefly talk about a relationship with the literature. So at least our work is related to two strands of literature. So there's now a very large literature on all kinds of networks, economic or social. And so here in the finance literature, for example, people have used personal networks of CEOs, of board members, and so forth. So those could be a social economic network that influence firm decisions. And also in economics, in IO, we've seen a lot of work establishing networks using the product and supply chains. Okay, so broadly speaking, we are related to that. Again, we're building equity relationships among all these firms, which is somewhat different from these prior networks. The other strand of literature is that there have been papers using partial data from the Gongshangju, from the Registration Bureau. An earlier paper, Long and Zhang, they look at industry clusters. Recently, there are papers, Michael and his co-authors, our team have using this network to look at investments made by SOEs and non-SOEs, among others. So I want to emphasize that in this paper, our goal is to build these equity networks, and we want to ask the question on whether in a network and the position in the network to be defined affect growth. We look at SOEs and non-SOE, but that's not the focus. All right, so look at the regulations. As I said, by law, firm registration rule, there are different versions. Companies of all types must register with this bureau, SAIC, and disclose a bunch of information, entity, all the shareholders, shares invested, capital raised, etc. And when there are changes made, these shareholders in the firm need to register again with the firm. And very importantly, when a firm delists, you go bankruptcy or disappear, by law, you also need to file with the registration. So based on that, based on this registration procedure, we're going to get all the information, all the snapshots year by year for a very long time period. The regulation went from a paid-in system whereby if you announce I'm going to invest 1 million in a particular firm equity, you have to pay that in within 2 years to a subscription system in 2014. Our gross test ended in 2013 because of the other data we need to use. But for construction of network, we also use subscribed capital instead of paid in, and the results are qualitatively similar. All right, so as I already said, this is a type of information you're going to get. So let me give you an example of how we construct a network surrounding a particular firm. All right, so here's an example, 上汽大中文, a Shanghai auto company. This is the ownership information, equity ownership information in 2020. We're listing, the largest shareholders and some minority shareholders. And then what we do is we go back a year earlier in 2019. Again, we got questions among potential survivorship bias. So as I said, the registration data includes all the newly added firms, that is newly added potential equity investors. And it also includes, the record of a firm disappearing from the registration data. So when we construct this ownership tree, we include all of that information. Here I'm showing you a sort of a starting from 2020 going back. We can start in an earlier year and work in the future. So the direction doesn't matter. What matters is we use information from every year and construct this dynamic equity ownership network. So you go back to 2019, if there's no change. If there is change, we update that. If there's no change, you go back earlier, and all the way till this firm was founded and entered the database, or all the way back to 1950. All right. So for every firm, we do this. We use this procedure to construct all its shareholders and all the equity investment it has made. All right. So 1985 appears to be the initial year for Shangqi Dazhong, this auto company. The current version of the paper, the ownership information, most of that ended in 2017. We are almost done to updating everything to 2020. So hopefully the next version, maybe in a few weeks, we will update everything up to 2020. But here I'm still using 2017. So this is the starting point, and we go back to the year the firm is established, or the 1950. All right. Some formal definition use graphic theory. A network surrounding a firm is a matrix, adjacency matrix of the firm. So here is an example of that company I just showed you, with its at the very center of this graph. And then you can see there's these local networks with a local center, and this particular network is related to other larger networks. So this example also shows the importance when we define centrality, right? How important, how central a firm is in a network or in a bunch of networks, is to use definition of both local and global. Local, what that means is, if you look at one of these little circles, that's a definition of a local neighborhood. Global, by definition, we look at the entire sets of networks based on equity relationships. So here's some aggregate pictures. Importantly, as I said, while we have information of all types of firms, we drop individually owned firms because information and an identity on individual is very hard to trace. And there are cases where one individual can have multiple IDs to establish many firms. So after we drop the individually owned firms, we're left with about 40 million registered firms, right, with a number of ownership types. And at the end of 2017, right, again, this ownership network, we do that year by year. At the end of 2017, about 5.6 million firms are in at least one network. That is, at least this firm invests in one other firm, or at least it receives investment from another firm, right? So it's not single, it's not completely single, all right? And then the rest of the firms are single. We identify the largest subnetwork. Firms are interconnected, and the number of firms in this largest subnetwork is about 2.3 million. And as I said, again, use a graphic theory. The local measure, we have in degree and out degree. In degree is how many investments, how many number of investment you attract. Out degree is how many firms you invest to, right? That's a local measure because it counts the number of branches in a graph that originates from one node, one firm, or the number of branches or arrows going to one node or one firm, right? Again, by definition, that's a local neighborhood. For global centrality, there are a number of measures. In the regressions, we use two, right? One is called a betweenness centrality, and the other is called eigenvector. So here are some maybe intuitive interpretation. What's betweenness? So first of all, in order to calculate this betweenness measure, we need to use information on all firms in the 5.6 million. As I said, 5.6 million firms are at least in one network. So what's betweenness? Basically, out of this 5.6 million firms, you pick any pair that's not firm I. So if I want to calculate firm I's betweenness, I pick any pair that's not firm I, let's say J and K. I'm going to count whether how all the possible paths connecting J and K, and I'm going to count how many paths, how many shortest paths that go through firm I, right? So the amount of calculation is actually pretty big. So we're going to look at any possible pairs. We're going to count how many possible shortest paths go through this particular firm, and based on all that information, we calculate the betweenness measure. So I come up with this idea that this is like a bridge. How many bridges these firms connect to other firms? This is the betweenness. And finally, eigenvector. We use the definition of an eigenvalue. So basically, for a particular firm, we look at the entire network, the entire matrix of the networks that involve this firm when we calculate the eigenvalue. So the important difference between eigenvector centrality and betweenness, again, as I said, betweenness, the key is how many shortest paths going through a particular firm. The eigenvector centrality, what's important is it depends on the importance of the firms connected with this firm, right? So the idea is that maybe a firm is not connecting to gazillion other firms. It just connects to a few other very global important firms. If that's the case, that firm should have high eigenvector centrality, right? So that's one way to interpret this, the difference between these measures. All right. Finally, we need to look at firm growth. Here, we need some financial accounting information. The only other source available to researchers at this moment is from the National Bureau of Statistics. We use data from 2006 to 2013. So we do a match. The matching rate is higher than 90%. I remember the number in 2013 matched. So one is 40 million, one is the ABS data. We have about just under 250,000 firms in 2013 that has accounting and financial information. All right, so based on that, we can look at growth. Here is defined by growth in assets. Okay, so now some results. Very quickly, as I said, we want to describe these the evolution of networks and the industry sectors that this investments go to. All right, so here's a table. Not surprisingly, if you look at the aggregate flow of equity capital to different big sectors, construction/real estate and mining attracted the largest amount of equity capital. Financial is different because financial, you have these very large banks. So you take out financial industry. If you look at the real sector, construction, real estate, and mining are the two sectors attracting the most equity capital. Here's a graph, the bar showing the number of in-network and out-of-network single firms. Obviously, the firms are growing very rapidly since 2000. And so is the number of firms in-network. As I said, the number is 5.6 in 2017. Line is the fraction of firms in a network. Now we're trying to establish relationships. These are correlation tests, if you will, between whether a firm is in a network, in the position in a network, and growth. All right. So as I already said, in degree is how many branches, how many firms it attracts investment. And then out degree is how many firms it invests. So here what it says is that when a firm invests in more other firms, it has higher growth. Perhaps that's not surprising. And then betweenness and eigenvector are both correlated. Higher global centrality is correlated with higher growth. If you look at economic magnitude, by far the most important measure is eigenvector centrality. So as I said, it's not just the number of firms you're connected, it's the number of important firms you're connected. All right. If you're connecting with more important firms, you tend to have higher growth. All right. Here we're doing some interactions. We're showing that if we look at the number of years a firm is in a network, we show that the global centrality measure, especially eigenvector centrality, remains very strong. In fact, grows larger the longer the firm is in the network. We also explore some heterogeneity of firms. In how much time do I have?
3 minutes.
Okay, good. All right. We show that if a firm has more financial constraint, the external financial constraint, it benefits more from in a network. SOEs and non-SOEs both benefit from in a network and a centrality, but non-SOEs benefit more. This can be interpreted as SOEs already has abundant financing from bank loans and other channels. So equity capital on top of that, the marginal value is not high. Next, we want to show the channels, as I said, through which these equity networks can help. So one interesting finding is that, again, through the registration data, we can actually look at not only the headquarter firm, but also how many branches it set up. So we find that for firms with a certain degree of global centrality, it tend to establish more branches in a location that are connected with other big firms, important firms. So this is perhaps one channel in addition to the equity financing that can promote growth. We also control for a number of possible other networks effects. So one thing is industry chain and production networks. So here, what we do is we figure out each firm's industry classification, and also we figure out the input table of each firm. All right, so for every pair of firm, we have this industry chain pair fixed effect. So I want to point out that after controlling for this industry chain fixed effect, the centrality measure still holds, especially global centrality. We also look at geographic distance. So here what we show is that for every pair, investor and investee, we look at the city, the location of the city. We also include the city pair fixed effect. Again, the centrality measure stays. We also look at, as I said, the 08-09 financial crisis happened. China have a very large stimulus. Importantly, the stimulus, about 3/4 of the stimulus was newly issued bank loans from state-owned banks. Okay, so we look at this shock, this financing shock. How does it affect the effect of equity network? We find that it works on SOEs and non-SOE differently. The idea is that for non-SOEs, they lack financing in general. So anything they get is helpful. For SOEs, they already have a lot of support from the banks. So the effect is further diminished. And overall, this bank loan stimulus crowds out the effect of the equity network. All right, so
you may want to wrap up.
I want to draw. So the final slide I'll show you is that we are trying to do some identification exercise. So we want to further use the 08-09 global crisis as a shock. It's an exogenous shock to China. It should affect export sectors the most. So the idea is that if you look at these equity networks, all of a sudden starting 09, a bunch of export firms disappeared. That will affect the positions in the net equity network of other firms. So we want to look at this shock to the equity network through the export sector, and we want to look at the performance of those non-export sector firms. Some are affected by the dropout of the next export firms, some are not, and that's sort of the idea. We're still running this test because it turns out we need to recover industry classification about 1/3 of firms. And the only way we can do that is using machine learning to extract information from this textual information, and text takes a lot of time. So I'm not going to spend more time summarize, but I'm just going to give the podium to the discussant.
Thanks a lot, QJ and Bohui. I think, QJ has done a great job in presenting, what they found in the paper. So just for the sake of time, we probably would just skip this summary. And those results, all of them seem very exciting and reasonable to me. So I will probably also skip them just to avoid repeating what QJ has said. So let me just jump to my comments. First of all, I think, this paper uses a fascinating data set. And the paper has found a set of rich and impressive facts. But as a discussant, I want to be critical, and I also want to be stimulating. So here is kind of the list of what I'm going to say in the next 20 to 25 minutes. I'm gonna start with some thoughts and perhaps a few facts on the evolution and origin of this firm-to-firm networks. So the way I think about this fascinating data set is, the data set is really about the whole universe of the Chinese economy. So if you guys are intrigued by the origin or the formation of our universe, then you guys should be equally intrigued by the questions like, how this economic universe was formed and how it has been evolving over time. And a lot of things have been covered by the paper. I just want to point out there's still a lot of intriguing questions to be studied, to be answered in the future. So for those of you who would like to address these issues, do please start working or try to work on this data set. And although my first set of comments are not so closely tied to the paper, it's clearly these are not comments or suggestions about the current paper. The second comment is really about this paper. QJ didn't really have time to talk about how they tackle with the identification issues. I hope I will have some time to talk about. Clearly I'm not an ideal person to talk about it. I didn't have any IV in any of my published papers, so don't take my words seriously. But I did have really hard time in understanding this IV. So I want to tell you, how I thought about it, and I want to know how you think about my comments. And the last thing is, once again, really we have to jump out of the box and think about what can we learn from this exercise? What do we learn from this fascinating data set from China? Is this really about something unique to China, or it's telling us some general implications of some standard theories? If I have time, I will briefly talk about these things. So the first thing I want to start with, some basic facts about this network. Once again, I don't want to pretend to be an expert in the field. QJ and some of his courses might be way more knowledgeable than me on this. But I just want to tell you, what I learned from the network literature as a beginner. So there are two very naive ways to think about the formation of this network, huge network. So one is what they call ER, random graph model. So basically using economics language is just a random search model. You just randomly run into someone and build up a connection. But important implication of this random search model is in the end of the day, the degree distribution will be just Poisson. And another way to think about it is equally naive, but it delivers a sharply different prediction about the in degree, out degree distribution. That is what they call the preferential attachment model. The idea is also simple. Better connected guys may have a better chance to be connected to other guys. So if you think about who are those better connected guys to begin with, maybe these big firms. So in the end of the day, you will have a connection based on gravity. Larger firms are more likely to get connected to each other. And from the perspective of small firm, small firm is also more likely to be connected to big guys. And why, I said that this model delivers some sharply different prediction is it because it implies a power law distribution for in degree and out degree distribution. So if you look at I'm using basically the same data set, although it's slightly earlier than what QJ uses in the paper. We use firm to firm network based on equity investment, and we look at giant component, that is the largest subset of connected firms. We didn't put it into any of our papers, but it's just for fun to show that this is not surprisingly in 2015. You see the out degree distribution is Pareto. It looks very much like Pareto. It's a power law. And in particular, if you look at the right tail, it's not perfectly Pareto, but it's very close. So perhaps this is not surprising. This is, you have seen this pattern in many big networks. But the intriguing thing is, well, if we bold enough to make, if we're willing to make some assumptions so that we can go back to the network a decade ago, then you will see a decade ago the network looked very different, quite different from the network 10 years, 11 years later. So within quite short period of time, you see, for instance, the left panel is the distribution in 2004, right? And if you look at the right tail, the two things different. Firstly, the whole distribution shifts to the right substantially. All firms on average are better connected. And the second thing is the right tail is very different. A decade ago, the right tail was not Pareto. And just within a short period of time, you see it looks more like a Pareto. So a very interesting question is, well, what are the underlying driving forces that lead to this pretty substantial, distributional change? So just making Chinese firms connection a lot more like Pareto, a lot closer, if you want, a lot closer to what preferential attachment model is predicting, right? And another related but different perspective of looking into this network. Here is a kind of simulation based on a statistical model. And once again, there's a different way of showing this network. We're using this version a few years ago, and we call it Galaxy. It's first Galaxy, just trying to engage a group of journalists at that time. This is the same firm-to-firm network, but we show it with different size, with different color. Different size, just each dot means a firm. Different size means different firm size, and different color measures. It's a rough measure about the capital cost. The red dots means these are firms associated with lower capital cost, means they are probably subsidized, and those green dots means they associated with higher capital cost, that they may be taxed one way or another. And what you can see here is, those large firms sitting in the center of this galaxy, basically state-owned enterprises. And they are old, they are state-owned enterprises, so they're associated with low capital cost. And those firms are sitting in the peripheral areas, they are privately owned, they are relatively new, and they are smaller. But that's not really what I want to say. What I want to say is, there, as QG said, a lot of firms that are not covered by this firm-to-firm network. That might be very important for us to understand the origin and the evolution of the economic universe of China. So let me try to start from the scratch. Here's how we think about a firm is set up by individuals. For instance, you can think about at the very beginning, you have an individual I, a startup, a firm A. And later on, if the business is successful, he might want to set up a different company B, for exploring, say, different business opportunities. And then, later on, they may want to introduce more complicated structures. For instance, for whatever reasons, this owner I may want to set up a new firm C and let firm A be the owner of C. Now here starts this firm-to-firm network that is the focus of the current paper, right? And the structure can be more complicated. For instance, they may ask someone from outside to be a joint owner of the new business. And what the current paper is studying is basically this firm-to-firm network in this extremely simple case. I want to point out that if you really want to, for those of you who are really interested in understanding the origin of the economic universe, and if you really want to understand a very early stage of firm growth, then you probably want to look at this part that is actually outside of the current firm-to-firm network. In terms of size, this part is probably less important because the firm-to-firm network accounts for basically more than half of the capital in this economy. But if you really want to understand what's happening at the very early stage, then this set of individually owned firms is extremely important. Another thing here I want to point it out, there's a look at this ABC that are owned by individual I and J. Well, one way to think about it is, although there is no firm-to-firm connection, but they are connected based on individual ownership, because B is jointly owned by individual I and J, and therefore seemingly unconnected the firm A and C, they are actually connected because of the firm B. So here comes to another interesting thing that is related to what I was talking about. You may actually want to study the second galaxy. Forgive me if I'm using imprecise terminology, but this is kind of one way we understand this thing. So in that galaxy, you have firm-to-firm connection based on joint individual ownership, instead of the firm-to-firm equity linkage. And this network, is much smaller in terms of the total registered capital, but this network consists of many more small firms. And this is actually the part, actually QJ showed us a picture. He showed us the firms that outside the network actually is the major driving force for the expansion of the universe. So this part, while this part, for many good reasons, this is not the focus of the paper, I just want to point out, the growth, the expansion of this type of firm-to-firm connection is actually very important over the past 2 decades. And another interesting thing is, look at those firms are sitting in the center of the second galaxy. Most of them are just private firms. And you may find these firms are actually, many of them are actually sitting in the peripheral areas of the first galaxy. They are actually in QJ's network. And these firms in the peripheral areas of QJ's network actually are sitting in the center of the second galaxy, which consists of many more private-owned firms. So once again, that just tells us how this universe was, how this second galaxy was formed, and why this second galaxy has been growing so fast. Essentially, those firms that are somehow connected to the first galaxy, to QJ's network, play a central role in pushing, in grow the second galaxy. And here is some kind of visualization. If we're bold enough to push the data all the way back to 1995, then you will find that the second galaxy was not even existent, and first galaxy was there, and first galaxy accounted for like 30% of total capital in 1995. 10 years later, the first galaxy accounted for half of the registered capital, and the second galaxy becomes significant, but still very small. Here's what you see, in 2015. And more precisely, you can see this relative growth of the two galaxies. So you can see the explosive growth for this firm-to-firm network was basically in the 1990s, and the huge expansion of the whole Chinese whole Chinese universe started in early 2000, and it continues to grow exponentially even in recent years. So I just want to say once again, it clearly goes beyond the scope of the current paper, but there's just a lot of interesting things to be studied, and a lot of interesting questions to be answered in the future by using this data set. And now let me try to be specific on one thing that QJ didn't really have time to talk about. That is education. I just feel annoyed by being asking about this education issues, because I wrote papers and some of the papers are often challenged by causal inference. I understand the difficulty of the question, but I also understand how severe the problem could be. Look at the ORS regression. Well, as QJ said, that these are just correlations, and the initial position of firm in a network is strongly correlated with its future growth. But it could be driven by many things. It could be just a selection. Investors would like to select a few firms with a stronger growth potential. It could be just reverse causality. For instance, the position, as I said, if you think about the dynamic position of a firm in a network formation model, then the position itself is changing over time. So this dynamic interaction may actually lead to reverse causality. So the issue is pretty serious. I just want to use one thing that we document in our paper. It's actually an evidence of our own failure. You see here is let's just look at the left panel. We just trying to show for those private owners that are not connected to state owners. At some point, some of the private owners, they start to have joint ventures with state owners. And we show, actually before they were connected, their performance is already different from those private owners who have never had any chance to be connected to the state. So it tells you, there must be some selection. Although the point of our paper is just to show where the slope is different before and after connection, but clearly you see a strong pre-trend. So the question is how to deal with this pre-trend. And QJ in the paper they construct an IV. They say that let's hypothetically drop the top 100% most connected firms, and then we compare the eigenvector centrality in the real network with the centrality in the hypothetically constructed network by dropping 100 the most connected firms. And I tried very hard to understand this, and I just don't understand it. So I tried to just tell you I tried to facilitate my intuition by having two examples. So here is one example. Firm Z is in the center of the network, and Z is connected to ABCDE. And if you take that out, then you see, the nice thing is you do see the first stage. The first stage works very well. But my question is actually, how does it help to satisfy the exclusion restriction? Does exclusion restriction applies here by dropping the most connected firm? If the selection is there, for instance, for whatever reasons, D and E associated with strong growth in the future, and D and E were strategically selected by Z. By doing this exercise, I don't see how we can alleviate this endogeneity issue. And worse, if I start with a slightly different network, just making B, previously B is connected to A and C, and now I allow B to be directly connected to individual I. Sorry, that should be Z, not the Z is the firm in the center. This is a typo. And then you take out the guy in the center. Then what you find is you see a strong correlation in the first stage, but the correlation turns negative. So it means somehow, of course, I don't think you're gonna see such a dramatic difference in a huge network with millions of firms. And there, I believe that the result will be just a lot more robust than those from the two extremely simple networks. But still, I had hard time in understanding, how what is the theory or what is the theoretical foundation that allows you to have a stable first stage, right? And the last thing I want to say is, what do we learn from China? So a lot of actually, I agree with all the findings in this paper, but I have to ask myself, this is something general, or this is something unique to China. There's some heterogeneous effects in the Chinese context, which also I think very reasonable. But if you replace China with probably a different country, I can also imagine those findings will apply. Although in none of the major countries we will have a state sector. So what are the things that are fundamentally unique to China? So we have done some exercise. This is just for fun. We use Orbis data, and we do this network analysis for Germany. And what we found is that Germany also has the two galaxies I just talked about, although relatively their size is a bit smaller than China. But basically in Germany, you also see the same thing. And one thing that is very different in Germany is, well, if you use a closeness as a measure, and then you check what are the firms that sit in the center of the firm-to-firm network, that is Galaxy 1, the focus of the current paper, then you find that, well, these are basically big banks in Germany. And in China, if you use the same measure, the closeness, what you find is that in the center of the first galaxy, in the firm-to-firm network, these are all big state-owned enterprises. Some big state-owned enterprises are banks, of course, but many of them are not banks. So that seems to suggest some differences. Of course, if you go along the way, then you will have to read our paper, right? But I'm not going to try to advocate our paper in this discussion. Instead, I want to think, more openly. What are the other things that could be unique to China, could have some Chinese characteristics instead of just a simple test of the general theory? For instance, if you think about
Michael,
China.
Sorry for the interruption. 2 minutes.
Okay, I will wrap up in one, actually. So if you think about China is a country with a lot of misallocation, a lot of frictions, then I think QJ mentioned Ernest Liu's industrial policy paper. So one thing to think about is actually improper linkage with frictions is going to be an important and promising way to think about why there are kind of more intensive firm-to-firm connections in China than in Germany. Just because upstream, downstream firms, they want to they want to reduce frictions in buying goods from upstream firms, and therefore they want to do vertical integration. Another, I think, interesting thought is, some markets in China are really underdeveloped. For instance, knowledge markets. China has a very underdeveloped patent market. So if you want to acquire patent, if you want to acquire knowledge, then you probably have just to buy the firm though that has the knowledge instead of purchasing the patent owned by the firm directly. So these are the things I feel like associated with some interesting Chinese characteristics that can be studied in the future. So I'm going to stop here. Just want to say, well, this is a fascinating paper, and just want to tell you, there are still a lot of things can be done in the future. Thanks.
Okay, thank you, Michael, for the great, excellent discussion. I think we have roughly about 50 minutes for Q&A. So maybe QJ, you can spend 2 minutes in replying Michael first, and then while we are waiting for other comments. Yeah.
So thanks very much to Michael. As usual, his comments are very stimulating and very, very helpful. So I'm gonna just quickly, and then we want to hear more questions. So Michael gives a very good illustration about what we're not using in the construction of networks, which is the role of individuals. I actually agree that's potentially interesting. So the nice thing about Zoom is that you can chat with your co-authors using WeChat. So we chatted a little bit. If you recall Michael's picture and our data, so we showed that as of 2017, out of the 40 million firms, these are not individual firms. And very importantly, when we construct the equity network, as Michael said, it's firm to firm, right? So we drop not only the individual firms, we also drop the individual investors, right? So, and we say that 5.6 million are in-network firms and the rest are out of network. So potentially, some of those out-of-network firms, which is the majority, might actually be somewhat connected through individuals, right? As Michael said, right, because he has this connection between the two universe. So that's potentially important. We have most of the data of the individuals. We could do something more illustrative. We did check on the aggregate before we start doing this. So if we add back all the individual owned firms, we find that, not surprisingly, the individual owned firms, the overall equity capital and the contribution is not big. It's under 30%. So the idea is that when we construct the firm-to-firm network, we're picking up more than 70% of all the equity investment in the universe of firms. That being said, I do agree with Michael. It's potentially interesting to see, especially the evolution, right? I mean, that is a fair question, that how did these unconnected firms end up in a network? And it may well be through individuals. And that's something that we can definitely do. For the IV, that's why we're doing more. So I personally think that what we've done is not sufficient. So that's why we're working on it, on a more test. Hopefully we'll have more identification tests in a few weeks, and we'll send it to Michael and anybody who's interested. I'll stop here and wait for more questions.
Actually, Michael, in the last comment, asked the question whether this is also
sure.
A phenomenon unique to China, and also could be generalized to other countries. And he used the case as the one in Germany. So I also had a similar thought. So maybe I missed your response. What is your thought on this part?
So again, that's also a fascinating question. We'll think we can do something, because I find, so all the bullet points that Michael lists are interesting. The ones that I find most interesting is sort of the missed connection, right? And again, I think here putting back the individuals might be interesting, right? So, the idea is that I think Michael's using an example in Germany. In a mature economy, these connections are more or less rational in an economic sense. Whereas in China, some of these connections, or a lot of these connections, and at least in the beginning, are not based on economic rationale, but perhaps through personal connections. So my answer would be, we probably need to show more to answer whether a lot of these connections. I mean, the angle is whether these connections are efficient in an economic sense. And perhaps one way, again, is we can introduce the role of the individuals in the evolution of this. But I agree, that's a very important question. At the moment, I don't think we are well equipped to answer that.
So, and before other ask question, one more point. So in the last part of your presentation, you show us about your identification strategy. You use the global financial crisis as the shock. So I just wondering, because that was a little bit fast. And for that shock, it will also affect the firm's growth to some extent, right? So definitely it will affect the network centrality and also the in-out degrees, but it also affects the growth. So, yeah.
You're right. So that's why the test we're running is that there will be shocks the shocks started in export sector, right? And that's going to affect these export sector firms' equity connections and positions. And in a second stage, when we look at when we do the different day, for example, when we look at the performance, you're absolutely right. We're gonna get all the based on the input table to look at those sectors that are not that closely related to export. We are only going to look at performance of those firms. But you're right. Again, when we get the results, I don't think there's going to be a perfectly clean in this setting. I don't think it's a perfect clean test, but hopefully, at least it will be better. Will be complementary to what we've done that Michael discussed. So at least I thought the shock was exogenous because it affected the export sectors the most in the beginning of the years. That was the intention. Okay,
thanks. Let's see whether we have any question from the panelists for the Q&A. And I think your co-author is very active in replying quite a lot of those questions. Yeah.
So can I ask you part of the question proposed by Michael? So you mentioned that it seems that the companies in the network contributed to roughly 30% in Germany, right? In terms of the firm numbers, but I'm not sure what's the real number for the total capital. For example, in our sample, it is true that companies in the network is only a very small, like roughly 10%. But this group of companies are much larger than the companies out of the network. In fact, this group of companies contributed roughly 70% of the total capital, either in registration capital or the real capital. So I'm not sure this is the true answer for the Germany. Yeah, for the Germany, maybe I think maybe this firm size distribution not so highly skilled, right? So maybe I'm not sure because I have looked.
I don't have a good answer to that. We did that a long time ago. We're using Orbis data. I think it can be done by checking firm reported sales. Yeah, but I don't remember we have done that. It's just for fun,
Yeah. Okay. Thank you. Yeah. In fact, we found that they, roughly speaking, companies, this group of companies contribute roughly also 70% of the total output. Yeah.
Okay. Thank you. I think there's a question from Zhiguo. Yeah.
QJ, this is a question I asked Michael too long time ago. This is when we see all these complicated structure, the usual terminology we call it is a pyramid structure, but I don't feel I don't feel that's the truth, because we were debating with Michael and the Changtai on what's the true purpose of this complicated I own you, you own that, A own B, B own C, all these things. And one of the reasons why would I say so, it's not pure simple pyramid structure, because typically we think of pyramid structure is a guy who can use a very small share to control a long chain of the empire business. But what we see in China seems to be that's also very, very prevalent in SOEs. Like even the SOEs that we know that who is the real boss behind, they are still doing like crazy 10 layers of complicated structure. Just, it's really puzzles me. And then nowadays, it's like even more and more so. I do not have a good answer to it. I also feel like it's either it's very deep or it's just a weird thing that maybe it's just glitch due to the process. I don't know if you thought about it.
So let me give a quick answer. So Zhiguo, that's an important question. We do have this in mind when we look at this. For SOEs, you are right. They do this. I don't know, quote pyramid or what. They have this layers of investment, right? If you remember, that's what we do in that second paper that you look at in the CICF last year. So in that paper, we explicitly, starting with different level of government, central or central SOE, local SOE, and then the others. And we trace the number of the routes, the tree branches. And we have some mixed results, like for example, some connection with the government is good, but if you're directly controlled by a not so efficient local government, maybe it's not good. This paper, I guess in this particular paper, we are more interested in the connections based on direct equity investment. That's one answer. Two, the global measure betweenness and eigenvector centrality are weighted by the investment capital or the fractional ownership.
Okay.
So in some sense, it should take care of, so the idea is that, but you're right. I mean, so we're not, in this paper, we are only, we're only, I guess when we calculate these measures, we don't focus on this indirect investment, right? Because we only care about the connection in this finance and growth. In the SOE paper, we try to answer your question by only looking at SOEs of different levels. There we say, we start with the origination of the level, whether it's the central government or a central SOE, and we go down, we track down how many times. You can go down like 20 some steps. For non-SOEs, the final answer, the non-SOEs, again, I feel if we don't recover the individual owners, we cannot have a very nice picture of that pyramid, right? Because here we only look at firm to firm.
Yeah.
That's my own interpretation. I don't know if Michael has better answers.
I will reach out to you for. I think Bernie has a question.
Yeah, I have two sets of questions. First is like what Jip was said about why this kind of cross investment arrangement. And I suspect that this may be connected with the pyramid literature. I think Wolfenson and Daniel Wolfenson and Hector Almeida, they have a general finance paper that talk about why firms would do this kind of thing so that the group can expand without losing control. But I haven't quite really worked out a paper matching with yours. It's just my hunch. Then there's a second question, and we work very hard on this endogeneities and so on and so forth. There are three things in my mind. I mean, clearly this network thing is related to the capital market status in China, et cetera, But I want to ask the question, a firm is very central in the network. Is this planned, or it is a natural evolution, or it is forced exposed? I repeat, is it planned ex ante, or it is forced to expose, or this is just a very natural evolution? And I mean, the endogeneity applies only in the ex ante planned version. In the rest, no. So I think the result is still very useful, even if we cannot fully sort out the endogeneity. The second question that is really, really bugging me is that, is it possible to look at your change in centrality? So I want to look at a firm that move up and move down. I want to look at these changes because this is very important in the following sense. We want China to practice survival of the fittest. We want China to really, allowing firms to go out, allowing firms to grow and go in, all these are very important issues. And so for me, what is interesting, what bugs me is that I really crave for some information on what drives the moving up and what drives the moving down, and what kind of firms they are that go up and go down. I think that will shed light on the economic selection in China. Thank you.
So these are all great questions, Bernie. To your second question first, very briefly, I think you touched upon very important. I think for different firms or different cases, I do think that for SOEs, there is this idea that they just invest at different levels in different firms. And then for some non-SOEs, maybe you see a more sort of organic growth in status and also in network positions. We've done some very simple test correlations on what affects centrality, but we have not studied very carefully on the evolution, as you said. We probably should spend more time. I want to say that in the regressions, even though they're not causal inferences, it's a panel where we actually calculate the centrality measures year by year. Let me stop here and take other questions.
Okay, thank you, QJ. Thank you, Bernie. I think probably we need to wrap up today's webinar, and I would like to take this opportunity to thank Professor Jun QIAN and Professor Michael Song, and thanks for your excellent presentation and discussion, and thank all the audience. I will transfer it to Bernie. Yeah, thank you.
Well, let me say the following. First, Peng Jun seemed to have a question. If we can handle that quickly, maybe we can try to give them 1 minute. And then I will pre-announce that the next meeting will be on March 17th. Zhiguo will present with his co-authors, and the paper is about incentive and firm investment, evidence from China's reform. It is a tentative title. He may change the title, and he may change the paper as usual. Usually that may be the case. I mean, for those that will need to go, please, by all means. But if it's possible, can we give 1-2 minutes to the last question, Peng Jun and Jin Jun?
Oh yeah, Jun.
And co-authors.
Thanks, Bernie. QJ, very interesting paper, and Michael, stimulating discussions. What kind of puzzles me or bugs me is always, why network? If we think about the ultimate model is kind of a CAPM type of factor model, what does studying this specific network really buys us? Your example of that German example is quite interesting. You see that Galaxy 1 is really just the banking sector distributing. I guess behind that network is how capital flows. So in Germany, it's banking sector. In China, SOE is at the center. If that's really the case, why do we need to study the network? We just capture these important players and then think them as factors, and then we move on. So I feel like network study is, I mean, maybe it's my bias. I feel like a lot of busy work, a lot of fascinating plots. But what do we really get out of these studies? That would be my main reservation. Although your QJ's presentation, Michael's discussion really makes me find the whole topic interesting. Maybe I will study more, but these are my basic reservations.
These are very good, excellent questions. I will give my own answer. Again, I mean, I study through this paper. I study this network theory. I mean, my own best answer is when I start a talk with the motivation. So, if you think about the general questions of how do you fund a unlisted private firm, if that were the question, I actually think that China is interesting precisely because China is not Germany, where these banks can, through their different channels, reach out to these firms. Or in the US, if you're an unlisted tech firm, one way or the other, these VCs will find you. An interesting question in China, other than maybe some individuals, these guys have nowhere to go. I mean, now they can go to Alibaba and use big data to get their financing. So I think in that way, these equity networks might be useful in two senses. One is, at least it will overcome this information problem. At least someone, a firm or someone like you, is interested in invest in a friend's firm, right? And then because you invest in that firm, you bother to do some investigation and so forth. That's the first step. And then why is it that not enough? And you look at the network. So one test we show is that you see that for firms with some status in the network, they seem to use the network to their advantage by setting up more branches. So it, so that maybe we should have more tests like that. So that's my own understanding, that it's not just a one-to-one relationship. So that's obviously very important. At least someone needs to invest you, other than yourself or your parents. Someone else invests in you. But then starting from that, whether you can have connections with more branches or more people. Now, in that process, as Michael pointed out, in China, there might be a lot of inefficiencies because our markets are not perfect, right? So that's sort of course, I'm shortchanging all these network theories and this. So that's why I think that it's multiple parties, and then once you go beyond one firm, then the structure of the network matters. So my final words is that I hope to see a network asset pricing paper from you in the near future.
Can I just add one thing? Jun asks a fantastic question. So my answer, my take to that is, network doesn't really make sense if you have a market already. But the problem is, if you think about China as an economy without fully developed markets, and you need to ask how markets are formed. Actually, we don't have sort of all the fully developed legal frameworks, and we still have a lot of things to feel, right, to learn. But that doesn't stop entrepreneurs from doing their businesses. So one way to think about it is, the network is a formation of markets. So if you don't have the price information, how do you allocate resources? And you have to do search, match, and all these things. That's exactly what a network can help. So, but that's my take on this. I'm just repeating what QJ said, I guess.
Okay, thanks.
Okay, thank you. Thank you, everyone.
Thank you, everyone. Thank you, Bohui. Thank you,
Thanks.
authors, discussions.
See you next time.
All the panelists. Wonderful session. I learned a lot. Thank you. And
Thank
thank
you
to the audience for joining us. And see you next time.